Target and Walmart both had monster drops last week because of earnings results. We're here to decide which one's the better one. They could both be great buys right now, but they fell big. Let's figure it out. So these are the two press releases for Walmart and Target with their earnings last week. So top line growth globally came in for Walmart at $141 billion, up 2.4%. Now, everybody who watches our videos knows I like to look at comparable store sales. What does that mean? Comparable store sales are stores that have been open for 12 or more months. Usually that's what it's considered. And you want to make sure that the sales in those departments are growing. And the reason being is it's easy to increase sales just by opening a lot of stores. But we want to make sure the stores that are already open are also increasing sales, right? That's important. So Walmart US comparable sales grew 3%, 9% based on 2 years. So guys, 3% growth in comparable store sales for Walmart. Let's go to Target and see what they looked like. Had comparable sales grow 3.3%. And they break it down. Comparable sales growth reflected traffic growth of 3.9%. So they both had very similar results here. It shows that, okay, last year they came off of COVID, had really big increases because people were finally able to go back to stores again. But even for this year, they still had reasonable growth in their revenue. Now, one of the things I want to point out that Target said, their operating margin was 5.3%, which was well below expectations. Here's why. They had margin pressure because of reduced inventory, as well as higher freight and transportation costs. Guys, everybody out there is feeling it. I know you don't feel bad for billionaire corporations. I get that completely, but that still will translate to the end user because as their transportation costs increase, they're going to end up increasing the cost of their products to account for that. They couldn't do it that quickly in this quarter, and that's what happened. Now for Walmart, they sit there and talk about consolidated operating expenses as a percentage of net sales increased 45 basis points, and they attribute it mostly to the increased wage costs at Walmart US. Now remember, Walmart's got locations all over the world. You know, we have homes in Manzanillo, Mexico, and there's a very, very popular Walmart there. But the wage increases, this is what I talk about when I've talked about other inflation before and wage increases. It will end up leading to higher prices for the consumer as time goes on. So that's the big thing from the Walmart perspective and the Target perspective in terms of what the results were recently. Now, both companies, we're talking about share repurchases. Here we have Target. During the first quarter of 2022, arranging up to $2.75 billion repurchase of their stock. What about Walmart? Well, let's go to the Walmart release. And right here, $2.4 billion. All right, so they're doing $2.4 billion in repurchases. Target's doing $2.75, very similar. So which stock should you own? Let's go put it through our software, stock analyzer tool. And guys, if you already have our software, please get on, listen to the channel, go along with us while we're doing this video because it makes a lot more sense while you're doing that. So I'm gonna pull up Walmart first. So let's go quickly, look at this drop right here. This is the big drop for Walmart. Incredible. Had a high of 160 this year. And they have a low of 117, which they are probably at, or pretty close. They're at 123 right now. Let's go to the 8 pillars tab to see where they stand. So right now, the PE is a little high, okay? And the 5-year free cash flow over the last 5 years has decreased $15 billion. Now, that's kind of concerning to me. So let me go up there and figure out why that is. So I go to the cash flow statement. And as you guys know in our software, we do the numbers here. But here's the big drop right here. Their cash from operations plummeted. And the reason being is changes in working capital. An $11 billion drop in changes in working capital did not help, as well as, let's see what else. Yeah, operating gains and losses was a huge decline. All right, so that describes it right there. So right there, this is really driving down the 5-year average. So let's go to let's go back to the 8 pillars. They've bought back about 9% of their shares in the last 5 years. They have very reasonable debt. Let's see here. Net income growth, revenue growth, higher return on invested capital than needed. So this is great. Now let's go to our stock analyzer tool to determine what price to pay for Walmart. Now remember, guys, every investment's the present value of all future cash flow. Those people in our community, I see that comment repeated over and over. Remember, Uncle Paul says that every investment's the present value of all future cash flow. Our job is to determine what that future cash flow will be. So we're going to do Walmart now, followed by Target next. So first off with Walmart, I'm going to do revenue growth numbers. Guys, look at this. It's Walmart. They're ginormous. In the last 10 years, they've only gotten 2.3% revenue growth, 3.3 in the last 5 years. You have to be conservative because of the fact that it's such a huge company. I'm going to do very little growth. I'm going to do 1, 3, and 5. The only reason I'm putting 5 in is, if inflation stays high for a while, they're probably going to have revenue growth that's pretty good for a while. Profit margin. I'm going to do 2, 2.25, and 2.5%. For free cash flow margin, I'm going to ignore last year's free cash flow because we saw it plummeted. I'm going to do 2.75, 3, and 3.25. PE. Guys, it's a huge company. I'm not doing a big PE. And I'm always going to do a 12.5% return for my margin of safety. I hit the analyze button. The company is currently at 123. My low range, 40 to 58. High range, 80 to 105. Mid range, 60 to 80. So you might sit there and say, geez, oh, Pete, fall in half. Well, guys, look at this. The current PE is 26. Why is Walmart getting a 26 PE? I give high PEs for companies with major growth potential and major moats. Do I think Walmart has a moat? Yeah, I do. It'd be hard to replicate Walmart right now, even at their market cap. If you said to me, Paul, their market cap's $340 billion. Here's a check for $340 billion. Repeat Walmart. It'd be very, very difficult. So that moat is definitely there. But the question is, does it still justify that? So what am I doing? I'm probably going to notify myself when it hits 78 or 80. So I'm just going to add the check mark to my watch list, notify me when it hits $80.75. And from there, I can decide what I'm going to do. Maybe the fundamentals have gotten better by the time that happens. That's still quite a ways down. It's also just fall by 33 more percent. But guess what, guys? It's already fallen 25% from this year's high. So not out of the question. All right, let's go to Target. And let's go back to our homepage, 8 pillars. Target, again, if you have the software, please follow along by opening up the software. Does this look familiar, guys? Literally a photocopy of Walmart, except the difference is Walmart went up a little bit. Target's going even further down. So Target's a $67 billion company versus 340. Their PE is higher than Walmart's right now. Their dividend. So, that's something I wanted to look at for Walmart. Let's go back and look at Walmart really quick in their dividend. Make sure it's a safe dividend. So Walmart pays about $6 billion a year in dividends. In the last 5-year average, $15 billion. That's safe. As long as it's under half, I'm good. And that 5-year average free cash flow is also already factoring in the $3 billion last year. So it's really about an average of $17 or $18 billion. They can easily afford that dividend. So let's go back to Target. Now, Target's free cash flow also dropped last year from its 5-year average. And look at their dividend. 2.4%, 1.6 out of the $4 billion. So about 40% again. So, okay. It's making sense. It's not, they're very consistent with each other. Return on invested capital, 5 years, 13.3%. Walmart's was 10.7. Let's go right to the 8 pillars tab. Now the difference is Target's selling for much lower PE ratio. Their cash flow growth drop wasn't as bad as Walmart's, but it's still there. They bought back 16% of their shares versus 9.7. But as we talk about, let's go to the stock analyzer tool and determine, based on our assumptions, a point to look at these companies. So revenue growth for Target, a lot greater than Walmart's. Look at this. They did 4.3% a year when Walmart was doing 2.3 over the last 10 years. So I'm still going to do very conservative numbers. Profit margin, higher profit margin with Target. They're, let's see here. I'm going to do 3.75, 4.25, and 4.75. Free cash flow margin, I'm going to ignore last year because it's such a random year. I'm going to do 4.25, 4.5, and 4.75. PE, 13, 15, 17, 13, 15, 17. And like always, 12.5% return. Hit the analyze button. The stock is currently 145. And based on the high assumptions, it's there. 168 is the value based on those high assumptions. Low assumptions, 90 to 100, and somewhere in the middle of 120 to 130. So guys, on this, if you believe all of these numbers right here, you're buying Target. If you believe this is possible, because you look at it, say, now granted, do more research, make sure you really feel comfortable, but if you believe these numbers, then Target looks like it's a buy today. Now for me, I like to be more conservative, so I'm going to probably sit there and put my my notification at 122. I'm just going to keep it at 122 even. Notify me. Guys, that was Walmart and Target. Thanks very much for watching.